morning. Good morning. I just want to test my sound just real quick. Should be pretty good. Sounds pretty good. Pretty darn good. All right, cool. So, welcome to this special live stream session with the release of the Consumer Price Index or the latest inflation data for the month of January 2024, which is set to be released in about 10 minutes at 5:30 a.m. Pacific Standard Time or 8:30 a.m. Eastern Standard Time. And this is going to be the first inflation report since the Fed made their decision to keep the interest rate steady at 5.25 to 5.5% last month. And Jerome Powell already said at the last press conference that they're not going to raise any more interest rates. So it's only a matter of time until when they decide to cut them. And it's going to depend on the report we're going to see today and many months after that. And the next FOMC meeting is not going to happen until March 19th and 20th. But many of us investors pay close attention to CPI every month to measure our purchasing power and inflation because it is a general indication of how our inflation is trending based on the Federal Reserve's monetary policies. And we want to see that it is heading in the right direction so that we can somewhat predict what the Fed might do next month. And in case you haven't noticed, I got a brand new camera, so let me know how everything looks and sounds, and I'll probably have to adjust the lighting in the future, but for the future live stream. But I just want to say that I appreciate every one of you tuning in or watching this on replay. But anyway, let me show you this. Okay. So we have the Consumer Price Index or CPI inflation coming out today for the January data. And then we have another one coming out on March 12th for the February data. And the next one is going to be just as important because that one comes out exactly a week before the Fed makes its decision to cut interest rates or keep them steady. And I'll be sure to go live for that one as well. So be sure to subscribe if you haven't done that already. And one of the reasons why the Fed hasn't cut interest rates is because of the labor data. And the private payroll for the month of January came out a few weeks ago, and it declined sharply from 158,000 jobs in December to 107,000 jobs in January. And leisure and hospitality reported the biggest increase with an addition of 28,000 workers, while trade, transportation, and utilities added 23,000 jobs. The construction industry also added 22,000 jobs. And this is the biggest sign or indicator, if you call it what you will, that the labor market is heading for a slowdown this year. This is the private payroll labor market. And this could potentially be a sign of an increase in unemployment going forward in 2024. And the Fed is paying attention to this because they don't want to see a recession with a high unemployment rate, right? And it is much more difficult to recover from a recession than from a high interest rate economy, believe it or not. However, the biggest victim that suffers in the high interest rate economy is the small business sector. Many small businesses have fallen in 2023 simply because it was much more difficult to borrow money to operate their businesses. And according to the U.S. Small Business Administration, companies with fewer than 100 employees are considered small businesses, and over 18% of small business owners failed last year in 2023, and that's really, really high, right? And the technology and information sectors have also suffered a decline or hiring freezes over the past year. And this is evident with all of the layoffs that are still happening across the technology sector. Now, that was the private sector, and that are in the sharp decline. But if you look at the overall U.S. labor report from last month, it is still looking pretty strong going into 2024. 353,000 jobs are how many jobs they added overall in just 1 month in January 2024. And this is still due to the fact that a large amount of people chose to retire early during the pandemic in 2020 and 2021. And here's where all the jobs went in January. So the hiring was led by, again, healthcare and social assistance, which added more than 100,000 jobs. the healthcare industry is still booming right now ever since the baby boomer generation started reaching the age of 65 several years ago. And the life expectancies are also expected to increase for the baby boomers, which will require more healthcare workers to help them with assisted living and medical care. And you also have to consider the increased need for physicians, pharmacists, and rehab services and workers across the country, right? And the U.S. Bureau of Labor Statistics is projecting the need for healthcare workers to increase by 19% just in 2024, and many more going into 2030. So let me know in the comment section down below if you're in the healthcare industry. Professional and business services came in second place with over 74,000 jobs. And since the pandemic, there's still a major shortage in the professional and business service sector, not just in the US, but around the world. And according to the US Chamber of Commerce, there's a major change or major shortage of architects, accountants, and lawyers. And I know we're also short of people in the overall financial industry. And when I say there are not enough accountants, there are really not enough accountants in the US. There's already a decrease in the number of people who took the CPA exam year over year. There's a little bit of an increase in financial planners or CFPs, but we still need more people. And sadly, accounting is perceived as boring to the younger generations, but it's actually a very, very rewarding job because there's a severe shortage of accountants, right? So a lot of companies tend to pay higher salaries. So if you're looking to switch jobs or start a new career, you should really consider getting into the accounting field or become a financial planner or a financial advisor. And as of last Friday, the unemployment rate remains steady at 3.7% for the month of January. And this is why a lot of investors are saying there are many signs of soft landing with inflation getting to the 2% goal without a recession. But I also think that the strong labor market is going to delay the Fed to cut interest rates a lot later than what people are anticipating. So if you look at the CME Group's Fed Watch tool, the Federal Reserve is making this decision to either raise, hold, or cut interest rates on March 20th. They're not going to raise it. And as you can see on this chart, the March 20th, most investors are betting on the Fed to hold the interest rates where they are at 5.25 to 5.5%. And I tend to agree with this with the labor market where it is. We're also going to see the PPI report or the producer price index on Friday, which measures the average change over time in the selling prices by producers. So remember that CPI is about the consumers and PPI is about the producers. And we're also going to see the retail sales report from the Census Bureau on Thursday. And the Fed will likely use today's CPI data and Friday's CPI data, as well as next month's CPI and PPI to decide whether they'll cut or hold interest rates in March unless something major happens between now and March 20th. And if you look at the May FOMC meeting, which is happening on May 1st, the market is predicting that the Fed will cut interest rates by 50 basis points with it's about a 7% probability. I don't see this as a possibility at all. And I think probably 50% is way too high for the rate cuts of even 25 basis points. And if the labor market stays strong, like we saw in January, then we're probably not going to see any rate cuts at all in March or May. So if you look at June 12th, the market is betting the Fed to cut interest rates with a 94% probability. If the labor market starts to cool off by then and the unemployment rate starts to go into the 4% territory, then I could see the Fed cutting interest rates by either 25 or 50 basis points. And I think 25 basis points is a higher probability, but I wouldn't rule out 50 basis points at this point. Let's take a look at the Cleveland Fed here for the projection. So the CPI projection today, year over year, is 2.9%, 2.94% to be exact. The headline CPI is also 2.9%. So this is going to be the first time we're going to see a 2% or 2 point something percent. I believe it's like since February 2021. And there's also a month over month increase of 0.3%. And the core CPI, which excludes the food and energy index, is projected to decline to 3.81%, which is hopefully it's good news, right? And 0.32% month over month increase. And I always try to look at the most conservative projections instead of what the news headline says. And I wouldn't be surprised if the inflation data comes out, say much lower than expected, but the last month CPI came in with a surprise. So who knows, right? But historically speaking, people spend way less money in January and February because it's right after the holiday. So we'll see what happens in a few minutes. But when the report comes out, I do want to pay attention to, oh, what did I do here? I didn't mean to do that. Oops. All right. So when the report comes out, I do want to pay attention to shelters because it's been the largest contributor to the monthly all items increase. And I know airfares are now at a 15-year low, which is really surprising because people are still traveling. I live in Las Vegas, and the Super Bowl just happened. The airport was jam-packed, right? It was insane. But that's also due to the low cost of fuel. And speaking of that, energy is another sector that we want to pay attention to in the winter months. And the two sectors that are really making everyone angry right now are auto insurance and homeowners insurance. And my insurance bill went up by 24% year over year. And so I would love to know if your car insurance went up at all in the live chat. So let's take a look at what Bloomberg is saying. I am curious what they're chatting about. The report should be coming out in less than 2 minutes. So let me know if everything sounds all right. Getting a brand new camera is exciting.
Regional sports networks.
So you guys know.
There's a lot of, it's a business that seems to be
How do I look?
collapsing.
There's a video.
Leagues have sort of toyed around.
Does it look cleaner?
Should we do something
Sound good?
ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network.
Okay, let me find another news because they're not really talking about it here. The report should be coming out shortly. You got Progressive. I have Progressive too. They've been good to me. I've been with them for a while, but I'm starting to think that, I might need to start switching. But looking at the CPI report, yeah, I don't know. Things are still not looking very promising. I'm not really sure what's going on with the, hang on one second here. The news is not showing, but let me make sure it is looking good. Should be coming out here. Okay, 20 seconds away.
On the Nasdaq 100, down about 0.7. In the bond market, let's slice and dice that Treasury market for you. 2-year, 10-year, 30-year, 10-year, 4.1482. Yields down 3 basis points on a 2-year, 4.44. We're down 3 basis points there as well. With your economic data, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. Well, you can see the frown on Jay Powell's face as the good news doesn't necessarily continue. CPI on a month-over-month basis up 0.3% year over year. That puts us at 3.1%.
That's
down
not good.
from 3.4,
Did not
but it's
beat.
not the 2.9% that a lot of people had.
Wow,
hoped
people are
for.
still spending like crazy.
The core rate comes in at a 0.4 rise, much higher than the 0.3 anticipated. That's a fairly strong core report. Leaves core inflation at 3.9% after 3.9% the month before. No progress there. So, John, you can give the scores. I'll take a look at the breakdown here and see where the problem is.
I'll get straight to it, Mike. I'm
The
sure you
Fed
can
is
guess
not
where we
gonna
are.
like this
We're
one, huh?
negative on the S&P
far.
500. We're down by 0.8%. As we often stress after economic data, the first move not always the right one, but we'll see
If you
this
have
one
any
sticks.
questions,
The Nasdaq 100
feel
is
free to put it
negative
in the live chat,
1.3% off
and
the
I'll
back
try
of
to answer as
hotter
many as
than
I
expected
can.
inflation.
But it's going to
Yields
be a
are
shorter
much
live
higher
stream.
at the front end. They were lower. The 2-year is higher by 10 basis points through 450 and close to 460 at 457.32. Yields are up at the longer end of the curve on a 10-year by 6 basis points, 424.95 on a 10-year. You push those moves through foreign exchange, you've got a stronger dollar and a weaker euro. We are negative on that currency pair by a third of 1%, 107.36. You put this data together with a strong payrolls print and decent wage growth. You put it together with a decent ISM services read and prices paid picking up, and you start to get a little bit more worried about maybe this Federal Reserve not being able to cut interest rates anytime soon. Lisa, I'd go back to that quote from Stuart Kaiser of Citi over the weekend and starting this week. That this CPI print has the power to toggle the storyline between soft landing and overheating. And here we are in the middle of February, and that conversation, I'm not saying it's running away with itself, I'll just say it's heating up just a little bit.
I think that that's what you see in the market. The idea of, just want to say, Earl Davis gets definitely a victory lap over at BMO Capital, where he was talking about shorting the 2-year. This sort of seems to edify that. But really, the key thing here is, if you're not seeing a broadening out, how long does the Fed have to wait? In other words, not only is this not as good data, but it kind of flies against some of the progress, which is the reason why I'm curious from Mike, honestly, John, whether we're going to see an ongoing sort of acceptance of broadening out with this data, even though it's not as good as previous data, because if it meets the threshold for Jay Powell or not.
Mike, we can all read the headline numbers. Are you seeing that broadening out? Are you seeing that disinflationary trend intact? What do you see beneath the surface?
Basically, we see some of the usual suspects here. One of the biggest reasons that we saw CPI come in stronger than anticipated was housing. Housing costs, shelter costs up 0.6% after 0.4 the prior 2 months. And the same thing is true of owner's equivalent rent. So home prices still pushing up, rent prices still pushing up the CPI. Gasoline prices, as you'd expected, went down 0.9. So that's the good news. But food prices were double what they were the month before, up 0.4 after 0.2. So food is something that consumers will notice. And of course, housing is propping up the CPI rate higher than the Fed wants to see. Many other things are down some. Apparel is up only 0.1%, while used cars and trucks were down 0.7. So we are seeing some progress being made. Used cars and trucks, down 3.4%, 0.7 decline for apparel. So we are seeing some progress in the areas that had given us problems in the past. But the big
let me show you guys what they're talking about here. So the report came in terrible. More terrible than expected. It was 2.9% expected, and it came in 3.1%. And the core CPI was projected to come in at 3.8. It came in at 3.9. So to me, it shows that even just for the month of January, people are still spending more money than the normal. It's been really interesting how resilient this economy, our economy, has been. And for one aspect that I would look at, maybe from a different perspective, is I don't think the entire economy is doing just fine. When I say people are still spending money like crazy, they're taking out debt to basically spend money. That was the case for during the holiday season. The credit card debt just reached 1.13 trillion. The rent in a lot of places are still not coming down as fast as they want to, but it is still a problem. I don't know if people do recognize that. And I know the Fed says, the economy is okay, but in another perspective, Some people are not doing okay because they're taking out debt to spend money. So that might be a misconception, or maybe it could be perceived as, oh, they're doing fine because they're spending money. Well, they're not really doing fine if they're borrowing, 25% in interest rate to spend money, right? But anyway, the report, when you read it, so 2.9%. I'm sorry, 3.1%. We were all kind of expecting that it was going to drop below 3%, because the core PCE dropped below 3% a couple months ago. I know it's a lot of nerd talk, so just kind of bear with me here, and I'm going to try to explain it as simply as I can. So what this means is that to the Fed is that the inflation rate is not coming down as fast as they really hoped. There were a lot of people were kind of hoping that in the month of January that the inflation rate will start trending down to 2.9, and the next month goes down to 2.8, 2.7, 2.6, right? And the Fed would, they've been talking about 2% target rate. We're not there yet. So, we're still at 3.1. It came down to 3.0 and it went back up to 3.1. So it's been a very long, dragging process. I really encourage you to watch his interview with the on the 60 Minutes. That was really interesting. But anyway, the biggest increase here was transportation services, which is really kind of alarming again, because right here at 1.0%, right? So if you look at transportation services, let me make sure that you can read that, okay? So transportation services had a 1.0% month over month. That's 1% in 1 month changes. And it's increased by 9.5% year over year. So it's not, it has been going up, and 1.0% is very, very significant, because normally you would see 0.1, 0.2, 0.3, right? The other one, the large increase was shelter. So that would be your rent, your housing, right? So that's gone up by 0.6%. Let me see if you guys can see that. So 0.6% month over month. So it is still a big contributing factor to the inflation. Let's see if anything went down. So used cars and trucks went down significantly by 3.4%. It went down, right? So that's a sign of deflation there. That is pretty significant, because the previous month it went up by 0.6%, and then the one before that was 1.4%. New vehicles are flat at 0%. And I really believe that a lot of vehicles are actually pulling back on their prices. So you might see some more vehicle prices drop in the future. Hopefully, they've been way too expensive anyway. A lot of dealerships they're losing money. Let's see. Energy went down another negative 4.5%. I'm sorry, that's fuel oil, negative 4.5%, and gasoline went down negative 3.2. So energy continues to drop. Food is still increasing. That's what's really killing inflation right now, is food. Food at home, food away from home, right? So restaurants and stuff, and then food at home would be like groceries when you buy it. But yeah, it went up. So food went up, transportation went up, apparel came down, vehicles came down significantly in negative 3.4. Medical care services went up, like really up 0.7%. I've been watching this, and it's been pretty steady at 0.2, and then we got 0.2, 0.5, 0.5 again, and then now it's up to 0.7. So, there's a little fear. People are kind of worried that this might accelerate inflation again if people start spending money like crazy. This is why the Fed they don't want to cut interest rates right now, because as soon as they cut, people are going to go out there and start buying houses. And I get that, everyone's goal is to buy a house one day, but as soon as you buy a house, you contribute to what's going on with the current inflation rate, right? So let's take a look at food. Yep. So food index rose 0.4%. Food away from home index actually rose by 0.5%. So, wow, the index for non-alcoholic beverages rose 3.4%. I wonder why that is. It's probably contributed to fruits and vegetables. So when people say that inflation is fine, it's really not. If you compare it to when people try to buy groceries, grocery bills are still going up, and that's why people are not happy with the general economy. If you really pay attention to what people are saying, it's not about, oh yeah, the Fed did a good job, dropping inflation and all that. But if you really talk to the people who are trying to, uh, go about their living, people are still struggling to buy groceries because their grocery bills are still up, right? And that's where this election year is going to be very interesting to watch. Energy, no surprises there. It's dropped. Not seasonally adjusted CPI. Okay, core CPI. I already read that. We don't need to look at the explanation, but if you look at a page like all the way down to about page 9, and that's where you can see like more of a breakdown of what's going on. You can look at like airlines. Oh, there's the one. That's the one we all want to see. What is going on with the motor vehicle insurance? Okay, this is the one that everyone is hating right now. Can you see this? Okay, I don't know if you. Let me see if I can highlight it. There we go. Highlight it. Yeah. So motor vehicle insurance. Do you see that? Okay. So if you want to look at the far right side, well, not far right side. So in the middle here, do you see where it says December 2023 to January 2024? Okay. So that is month over month change. And then this on the left side, I'm going to show you what the year over year change. But this is the year over year change. January 2023 to January 2024. That would be the, can I write that? No. Okay. So anyway, it went up again, 1.8%. Take a look. So this is car insurance that went up 1.8% month over month. So from December 2023 until January 2024, the car insurance rates, premium rates in general went up by 1.8%. And year over year, it's gone up by 20.6%. That sounds about right because my progressive, I don't have anything against them really, but everyone's car insurance rates have gone up. Homeowners insurance have gone up. That's a different category, by the way. I can show you that later on if I can find it. So that is very ridiculous with the 20.6. There is a CNBC video that did a piece on why your car insurance rates are up. Take a look. CNBC did a piece on that. It was really interesting. Airfare, it went up again. So people are still traveling like crazy, man. So airfare 1.7% month over month, but it is on a deflationary pace at negative 6.4%. So they're right about the airline fare is coming down year over year. Okay, so that's how you look at it. But I do want to look at the new vehicles. Used vehicles have come down negative 3.5%. That's really interesting. So if you want to look at used cars and trucks, it's at negative 3.5. Shelter, that would be rent or primary residence here. Okay. So it has increased by 6.1%. Okay. Let me look at some other things. Let me make sure I didn't miss anything else. Energy. You can really dive into this too, which is really interesting. Like you can look and see what's going on with inflation, right? If you guys remember the egg price crisis when the egg prices went up by like 20%, which was insane when it happened. I saw a lot of memes about how to go on a date is bring a basket of eggs or something. I thought that was pretty interesting. Let's see. Steaks, beef steaks are still going up 0.6%, 10.7% year over year. Ham is coming down. So, if you don't want to eat beef, you can always eat pork. Chicken is still going up. Eggs have calmed down, negative 28.6%. It has increased though steadily at about 1.8%. It looks like fish and seafood are coming down, and then pork is coming down. Steaks, beef is going up. So, milk is coming down. Cheese is coming down. Fruits and veggies are going up again. So it might just, it could be one of those seasonal things. So won't worry about it too much. Yeah, if you're a soda fan, let's say soda's not pop, okay? But yeah, it looks like carbonated drinks have gone up pretty significantly. I'm not sure why. Could be a supply thing. And sometimes you'll see like a jump, numbers that jump from like negative 0.1%, and then the next month it goes to like 3.3%. It could be many indicators, right? It could be because of what's going on in the Middle East, the Red Sea, and the supply chain. When it gets interrupted, the prices do go up. So let's see. Appliances are coming down. That's due to the fact that people are not buying houses, right? Clothes are still going up. Apparel, that's how you look at it. You can go into the breakdown of apparel. Sports vehicles, alcoholic beverages. Some of you guys' favorite, I guess. It's going up by about 2.3%. I'm a bourbon fan. Let me know in the live chat if you are too. I'm not seeing any crazy increase month over month. Medical care services are still going up, and that could become a problem for the baby boomers going into retirement ages. Okay, we already talked about the motor vehicle insurance. Yeah, so disappointing report, very disappointing. I think they probably could have done better on many, I don't know. I don't know if they're just keep the interest rates as they are or keep the interest rates where they need to be. It doesn't really matter. We'll see what happens next month. Yeah, I hear you, man. The progressive, it's gone up in price. I think I was paying like $200 a month. No, less than that. It's like 180, and now I pay like pretty close to 300 a month, which is insane. My driving record's pretty good too. Wow, USAA too, huh? Yeah, it's pretty much across the industry for sure. For USAA, what do you guys think of the new camera? Does it look pretty good? The blurry background, it looks kind of professional, much more professional than the one before. I think we're going to be fine in 2024. And when I say fine, it could be, you know, how you measure that really depends on each person, right? Some people could say the economy is really terrible because my personal finances are not doing well. That's fair. That's fair. Some people say that it's they're going to measure it based on the stock market return. They could do that too, but then the stock market doesn't necessarily correlate with what's going on in the U.S. economy. So it really depends on who you ask. And you could also say, hey, while the unemployment rate is low at 3.7%, the wage growth is still there. But you could also argue that many people in the tech sector are still getting laid off this year. And a lot of companies are heading towards AI to kind of like cut the labor costs. And that could potentially become a problem because the tech sector is the heaviest in the as far as the stock market goes. But the stock market tends to love labor cuts. I know that's terrible to say, but because labor is the most expensive line item, the highest expense line item that on the balance sheet is labor. When you cut people, they increase their profit margin. So, as terrible as it sounds, that's usually how it goes. So okay. Oh, good question. Yeah, I'll answer some retirement questions. So that is a good question. So somebody asked me, hey, does the rule of 55 apply to the Roth account, Roth TSP? It doesn't, unfortunately. So if you have a Roth 401k, Roth TSP, we'll talk about TSP for this segment. If you have a Roth TSP, the rule of 55 actually does not apply. TSP is a little different, but what people do, does that mean you should stop investing in Roth? No, it doesn't. So let me back up a little bit. Rule of 55 means that you can start taking distributions or withdrawals from your TSP starting at the age of 55 if you retire, quit your job, or get laid off or get fired from your employer with that that TSP in the same year you turn 55 years old. Okay, so the rule of 55 allows you to take traditional TSP penalty free. You're still gonna owe income taxes on it, but you're not gonna be penalized for the TSP distributions. So it's the early distribution under the rule of 55. But it doesn't apply to the Roth TSP because there's actually a guideline in the TSP manual that says that you have to meet two things. So I'm gonna go ahead and share that screen here and show you guys what I'm talking about. So for early distribution, you have to meet two things. Okay, so this is for Roth TSP. You have to have TSP for at least 5 years. So it doesn't matter what your age is. You have to have it for 5 years in order for you to take tax-free and penalty-free distributions from contributions and any interest and earnings that accrued inside the Roth TSP. So let's say you're 57 years old right now. You just started working for the Fed. You still have to wait until you're 62 to be able to distribute from the Roth TSP. Okay, that makes sense. So the second rule, what was the second rule? Roth TSP, you have to have it for 5 years. The second rule is you have to be at least 59 and a half. Both rules have to be met. Okay, you can't just be 59 and a half and have 3 years. Can't do that. You can't have 5 years and you're still age 57. Okay, so both rules have to be met in order to have penalty free and tax-free distributions, which means withdrawals. All right. So how do you go around it? There's one way. There's one way to do it, and that's what a lot of early retirees do. How do I go to the new page? There we go. Is actually do what's called Roth TSP to Roth IRA rollover. Okay, so when you do this rollover, you're just making a transfer from TSP to Roth IRA. So if you have, let's say, I don't know, so you have $500,000 saved. You just basically do the same transfer of $500,000. So let's say out of that $500,000, you contributed $200,000, and then your interest and earnings are $300,000. Okay, so what's nice about the rollover is that it just automatically does the cost basis for you, and it shows you that you have 200,000 contribution, okay, and then you have 300,000 in interest and earnings, or earnings and interest. So pay attention to this, okay? So when you make the transfer, make sure you know what your cost basis is in your traditional TSP. So let me go a little bit further. So if you have a C fund let's say you have 100% C fund. I'm just going to make it easier. All right. If you have 100% C fund and you've been investing for the last, I don't know, 20 years, and you have $500,000 in there. Okay. So you want to go into the cost basis. It should be under investment performances when you log into the TSP. And it's going to tell you how much you contributed to the TSP. So your contribution is $200,000. And then because you contributed $200,000, you have accrued $300,000 in earnings and interest. When you roll it over to a Roth IRA, it's going to be the same thing. So when you, let's say you got a Vanguard Roth IRA, it's going to tell you that you have, again, $200,000 in contribution and then $300,000 in interest and earnings. That makes sense so far. Okay. Right. And what happens is when you do, I'm going to use the same example. Okay. And let's say you have the same thing, 200K, and you have 300K. What between the ages of 55 and 59, let's say you retire at 55. Okay. Then you want to start taking withdrawals from the Roth IRA after the rollover. Take out the contributions first. Okay. So it's a first in, first out. You ever heard of that? FIFO, it's first in, first out. Okay. So when you take money out of the Roth IRA, when you start taking the contributions out, you're not going to be taxed or penalized for that because you already paid taxes on the $200,000 in contributions. Okay. Now, you have to kind of have your own plan to make that $200,000 last between 55 to 59 and a half. You should be able to, because you're going to have a pension and you're going to have traditional TSP to cover, to give you additional income. And this right here becomes tax-free and penalty-free when you turn 59 and a half. So you really just have like 4.5 years until you can touch that money. And think about how much money you can grow for 4 years with $300,000, right? You know what? Let me go into the spreadsheet here. I do have it. Yep, I still haven't pulled up from the previous day. So let's say your income is $36,000 right now. Oh, I'm sorry, $60,000 right now. And your savings rate 15%. You just keep it at 15% for the rest until the day you retire, with the 5% in employer contribution. And we'll just assume that the stock market does 8% average annual return every year. You average it out. It's not 8% every year. You just average it out. Right now, the average return for C fund is about 13%. So if you continue to work 26 to 40, okay, let me zoom out a little bit. You're going to have right here, let me see if can you see that? You're going to have about $508,000 by the time you're 40. Okay. How incredible is that, right? So let's go ahead and keep going. And there we go. If you continue to work until 55, you will have $2.1 million invested in your retirement. And your total interest, I'll have to do some calculation on that, but your total interest will outgrow your total contribution. So you have to kind of keep this in mind about how much you contributed, this one right here, personal contribution, and you want to add them up from here, from the beginning here, all the way down to the end. Okay, so all the way down to age 55, you add those up, and that should give you, over 6 figures. And you could have like, let's say $300,000, $400,000 in contributions, but and you have over $1.5 million in earnings and interest. So remember, going back to it, Roth IRA, you always take out contributions first because you already pay taxes on it. The next one is normally conversions. And then the last one is earnings and interest. You will get penalized if you take that money out, $300,000 here, earlier than 59 and a half. So to answer your original question, do you get penalized? Can you do a rule of 55 with the Roth TSP? No, you cannot. You have to. The one method that you can do, as I showed you here, is to roll that over to a Roth IRA. Great question, though. That's good. That's me just nerding out the moment, you know. All right. Looks like the market is not happy, just based on what I'm seeing here. Of course, they're not happy based on what we saw just now. Let me know if you guys get some value out of that, about the retirement calculation. Do like doing some of the Q&As every once in a while. Let's see. The markets. Whoa, man, the market is not happy right now. Let me show you this. Oh, yeah. S&P 500 is down 1.2% pre-market, and the market's not even open yet. So today, guess what I'm doing? Man, it's gonna be pretty exciting. I think I'm gonna be buying some stuff today. Yeah, looks like the market is not happy with what's going on here. Wow. Yeah, Dow is already down over 340 points, getting close to pretty at a 1% right now. So it looks like the market is not reacting well to the inflation that came out this morning. But anyway, I gotta take my daughter to school. So I appreciate all of you guys being here. And if you guys are catching this on live stream, I will make sure to leave the timestamps below. But I am so happy that I got this brand new camera with a little blurry background, and I'm looking a little sharper than I used to, right? So, but anyway, I will be live streaming again next Wednesday to talk about the dividend investment. So be sure to subscribe if you haven't done that already.